CVS Health isn't usually the first name that comes to mind when we talk about biotech breakthroughs. But what if there's a powerful transformation quietly unfolding behind those pharmacy counters and retail clinics? One that could position CVS as one of the most underrated biotech stocks in the market today. This isn't just about prescriptions and flu shots anymore. CVS is evolving into a biotech-enabled healthcare force, using its vast patient network, data infrastructure, and bold acquisitions to revolutionize how medical innovation reaches people. From personalized medicine and AI-powered diagnostics to decentralized clinical trials and digital therapeutics, CVS is quietly becoming the delivery system for the next wave of biotech breakthroughs. So here's the big question. Is CVS just a safe, slow-growth healthcare stock? Or is it transforming into a next-gen biotech infrastructure giant hiding in plain sight? Before we decode the biotech upside, hit that subscribe button and join the Stocks Telegraph crew for weekly deep dives. And drop a comment below. Do you see CVS as a boring value play or a biotech rocket in disguise? CVS Health has transformed itself from a traditional drugstore chain into a vertically integrated healthcare powerhouse. Key to this evolution are its acquisitions of Aetna, Signify Health, and Oak Street Health, moves that bring insurance, home care, and value-based primary care under one roof. The Aetna acquisition in 2018 gave CVS a direct link to millions of insured lives. Signify Health, acquired in 2023, brought home-based care and 10,000 clinicians into CVS's ecosystem. And Oak Street Health, bought later that year, added a fast-growing network of primary care clinics serving Medicare patients. Together, these assets form a platform where biotech-enabled care can be delivered directly to patients at scale. On the biotech front, CVS has rolled out precision medicine initiatives like Transform Oncology Care, developed with AI-powered company Tempus. It's also hiring leaders specifically to expand its precision medicine and genomics offerings, signaling its long-term commitment to tech-driven healthcare. CVS's strength lies in the combination of massive data access and national reach. The company has records on over 100 million lives and operates nearly 10,000 retail locations, meaning it can both identify eligible patients for clinical trials and physically deliver biotech innovations at scale. This data scale powers its decentralized clinical trial platform, launched in partnership with firms like Medable. CVS offers site-based, remote, and hybrid trials, making it easier for biotech companies to enroll patients and run studies outside traditional academic hospitals. From remote diagnostics to wearable device integration and digital health monitoring, CVS is acting as both a conduit and a co-creator of biotech innovation. The company's involvement in multiple stages of the biotech pipeline, from recruitment and trial management to patient monitoring, creates a unique synergy that traditional healthcare companies lack. CVS has a strong financial base. In first quarter of 2024, revenue rose 3.7% year-over-year to $88.4 billion, and it produced $4.9 billion in operating cash flow. It also boasts a dividend yield of 3.6%, rare for a stock with biotech exposure. Its Cordavis division is launching biosimilars in partnership with global manufacturers, an important revenue stream as biologics lose exclusivity. Its acquisitions of Signify and Oak Street are expected to boost long-term profitability as value-based care gains traction. Despite these innovations, CVS trades at a low PE ratio of 11.1, far below the peer average of 25. That makes it a rare combination, a value stock with a growth story hiding inside. Looking forward, analysts expect CVS to generate $350 billion in revenue in 2025. It's this blend of financial stability with strategic innovation that gives CVS a unique edge in today's market. CVS is enhancing its health hubs and minute clinics to deliver more personalized medicine, often in collaboration with payers and health systems. These locations are increasingly being used as entry points for diagnostics, monitoring, and chronic care. Its acquisitions have positioned CVS to deliver bundled, value-based services that combine insurance, pharmacy, diagnostics, and biotech delivery. That's a massive differentiator in a fragmented healthcare system. And let's not forget network effects. CVS has national reach and brand trust. That makes it incredibly difficult for new entrants to replicate what it's building. The infrastructure is already in place, and that scale becomes a competitive advantage few can match. Regulatory scrutiny around pharmacy benefit managers, PBMs, is intensifying. The FTC is investigating whether PBMs have contributed to higher drug prices, a probe that could lead to regulatory actions affecting CVS Caremark. Meanwhile, integrating major acquisitions like Oak Street isn't easy. Operational missteps could lead to cost overruns, missed targets, or reputational damage. And while its biotech strategy is compelling, monetization may take time. Investors might not immediately reward CVS for infrastructure moves that lack near-term revenue visibility. The path from investment to payoff could be longer than Wall Street is willing to wait. Wall Street is cautiously optimistic. CVS holds a moderate buy rating from 21 analysts with an average price target of 70.41, a modest 4% upside from recent prices. Evercore ISI is more bullish, calling CVS an all-weather outperformer and setting an $80 target. On the institutional front, hedge fund Glenview Capital made a $700 million bet on CVS and is pushing for more aggressive profitability initiatives. Motley Fool Asset Management and insiders like director Michael Mahoney have also increased their holdings, signaling long-term confidence. However, not all insiders are buying. SVP James Clark recently sold shares, a routine move but still something to watch. Institutional investors appear to be positioning CVS as a defensive biotech hybrid, a low-risk way to gain exposure to high-growth biotech trends without relying on volatile early-stage drug developers. CVS Health offers the best of both worlds. For traditional investors, it's a stable, dividend-paying healthcare giant with predictable revenue and defensive sector exposure. For growth-focused investors, it's quietly becoming the infrastructure that biotech depends on. This isn't a flashy clinical-stage biotech stock swinging for an FDA win. This is the company running the trial, distributing the drug, monitoring the outcome, and feeding that data back to biotech developers. That makes CVS one of the few companies where you get biotech tailwinds without biotech risk. It's a bet on scale, infrastructure, data, and delivery. If you want growth with stability, innovation without extreme volatility, and a long-term play on the future of personalized, distributed healthcare, CVS may be the biotech stock you didn't know you were looking for. So what's your take? Is CVS the biotech play hiding in plain sight, or just a healthcare giant dressing up in innovation clothes? Drop your take in the comments. Are you seeing the long-term biotech thesis in CVS, or does it still feel like a traditional value stock to you? We want to hear how you're positioning around this one. And if you're into deep dives on under-the-radar stocks with breakout potential, especially those flying just below Wall Street's radar, smash that like button, subscribe to Stocks Telegraph, and ring the bell so you never miss a smart investing idea. Thanks for watching, and we'll catch you in the next one.